if you're a beginner in trading or looking for some top tier trading knowledge, then this is the course for you. This is the full beginner's guide, full beginner's course, part 1. And in this series, this part, we're going to be going over market structure. Now, this is going to be a fully raw, transparent, no cuts course. So you guys have me just basically directly talking to you like we were in a classroom where I'm teaching you. So like I said, this is going to be market structure. We're going to go over the basics of market structure. After this video, I can guarantee that you will know what market structure is and how to identify it. It's very simple and it can be explained in a simple way for you to understand. So the first thing to understand when we're talking about market structure, you need to understand highs and lows. You need to understand what highs and lows are, and you need to understand how to identify them. So that's what I'm going to be showing you right now. So we're going to get rid of all this stuff right here, and I'm going to draw out a simple diagram of highs and lows for you guys to look over. So we're just going to do something like this. This is a basic form of a chart, right? So now if you're looking at a chart right here, where would the highs and lows be? Well, I know where they would be, so let me go out and identify one of these highs and lows for you guys, and then I'm going to show you why this is a high and a low. So this is a high right here, this point, and this point right here is a low. So why is this a high and this is a low? Well, it's simple. You see, represented by this simple diagram, price comes up and then it pivots down. When price goes up and pivots down, that pivot that it leaves is a high. And then if you see here, price goes down and then it pivots up. That V-shaped pivot that it leaves is a low. So V-shaped pivot at the high, price comes up, pivots down, that's a high. And for the low, price goes down and pivots up, and that's a low. So now that you know what a basic form of a high and a low is, where are the other highs and lows on this chart? Well, I will show you. It's pretty simple. We got a high here. We have a low here. We have a high here. We have a low here. We have another high here. We have a low here. And then we have another high here. Alright, so high, low, higher high. The reason this is called a higher high is because this high is higher than that high. That's literally what it is. So we have high here, low here, higher high, higher low. This is a higher low because it is higher than that previous low. Then we make a new high, so this is our new higher high. But then what happens here? You see this low is lower than this low? Well, the break of this low is something we'll get into later, but that is a market structure shift. So see, this low is now lower than that low after previously the lows were going higher than the lows. This means price has switched directions, and we'll get more into that later on. So now what is this? Well, this low is lower than this low, so this is a lower low. And then you see we come up, we make a high, but this high is lower than this high. So what is this high? This is a lower high. And you see price goes down, it breaks this low. So now what is this? Another lower low. Price comes up, it goes down. What does it leave? A higher high. So this is the simple form of understanding what highs and lows are and how to identify them on this simple graph. After this, I'll show you how to identify them on an actual price chart. So just remember, there are obviously highs and lows. Then there's higher highs, which are denoted by HH. There's higher lows, denoted by HL. Then there's lower highs and lower lows. So there's just basic highs and lows. There's a higher high, higher low, lower high, lower low. Remember, this is a high, this is a low because there's no previous high or low before this. Then this new high is higher than the previous, that's a higher high. This new low is higher than the previous, so that's a lower high. Sorry, a lower low. Higher low. goodness gracious. Then this is lower than that low, so this is a lower low. This high is lower than the previous high, so this is a lower high. It is that simple. So you have higher highs and higher lows when price is going up. You have lower highs and lower lows when price is going down. So now that we did that, we're going to show you how to identify them on an actual price chart. So if we look here, now this is on the 15-minute, so there's going to be a lot more highs and lows, higher highs, lower lows, all of that. There's going to be a lot more because the 15-minute chart, each candle is representing 15 minutes of data. So we're just going to start off and identify a high. So if we look here, we see price comes up and then it goes down. You see how it goes up like this and then goes down. It leaves that pivot point. That is a high. So we're going to start here with this high. All right. Then what do we see? Price goes down and then it goes up. All right. So this pivot point right here, which has this very long wick, all of this is a low, and I'll zoom in to make it a little bit easier. So you see how price comes all the way down and then goes all the way up. This candle with all this wick is a low. Now you see how price comes up and then goes down. So what is that? This would be a high. Now there's something you need to look at here. You see how there's these previous highs or these previous lows to the left of this, and see how price goes underneath these lows. So let me mark out this low right here. Obviously this is a low because price pivots down and then it pivots up. So this is a low. So you see how we have this low, we have this high, and then we go below this low. So remember, when price goes below a low, we have a low that is lower than the previous low. This would now be what? This would now be a lower low. So this is a lower low. Now you see price comes up, it goes down. This point is a high, but you see how this high is lower than that previous high. Now that is a lower high. Hopefully this is starting to make more sense. Now you see price comes down, it pivots back up, it leaves this low here. What would this be considered? Well, this is again a lower low. So we'll denote it like this, lower low. Now you see how price goes up and then pivots down. What does this do? This leaves a high here. We'll circle it. So now this high is a lower high. Hoping this is making sense for you guys. Now, this is something you got to really pay close attention to. You see how we go down, we pivot down, we pivot up. So this is a low now. This low, the candle bodies are slightly lower than that one, and we'll go over what candle bodies are and how to identify them. So this would be, again, lower low. And then you see, but wait, does price make a lower high? No, it goes up. And what does it do? It goes above this previous lower high. So it breaks above that, it goes up, and then it pivots down. So we have a high here, yes we do, but what is this? This high is higher than this previous one. So this is now a new high, but it is also a higher high because it is higher than the previous one, right? The price goes down and it pivots up. So what do we see? We see a new low. However, this isn't a lower low. Why? Because it's higher than this previous low right here. So now this would be a higher low. I'm hoping this is making sense to you guys. Remember, the basic way to do it is just start with a high and a low, and then when price goes below that high, when price goes above that high or goes below that low, then you start tracking your lower lows and lower highs. So think of it as this, right? If we don't look at previous price data, we can just think there's this right here as just a low. We can think of this high right here is just a high. So we have a low, we have a high. We go below this low, create a new low. So this low is lower than this one, lower low. Create a new high. This high is lower than that one, lower high. And then so on and so forth. And then we break a high, create a higher high, and then we create a higher low. It's really that simple. That is how you identify highs and lows, how you identify a low, a high, a lower high, a higher low, and a higher high. So now that you know the basics of highs and lows, you need to understand how to actually use these and how these apply to market structure. So again, I'm going to go to the simple diagram again, and we're going to draw out this diagram right here. So we already know what the highs and lows are, right? We know how to identify them. So we're just going to identify them here. So look, this will be our first high, right? This will be our first low. Okay? So we have a high, we have a low, and we break above that high. So now this new high is a higher high, right? But what does that mean when we create a higher high? Well, if we draw out a line from the previous high that is broken, we have a high, we have a low, we have a higher high. What does this mean? This means that price is bullish, and bullish just means that price is potentially going up. Think of it as potentially going up, not just going up, because it's not a definite, but it's a possibility. This is a sign that the market is potentially going to go up. So when we create a new higher high, that's showing that price is bullish. But what is this called, this break of this high? Well, this break of this high is called a market structure shift, or MSS for short. You can also call it a break of structure, whatever you like. Let me type it here. Market structure shift. You can also call it a break of structure, or BOS for short. Specifically, this is a bullish market structure shift. Remember, bullish means going up. Market structure shift is when a high or a low is broken. All right, so now we're going to look at it on the other end. So we have a higher high. What do we have here? We have a higher low. Remember, why is this a higher low? Could be because this low is higher than this previous low. Again, what do? We create a higher high. Remember, when we create a higher high and break the previous high, that is also known as a market structure shift or break of structure. Now, what do we see here? You see how this changes? What happened with this low? You see we did not create a higher low like in the previous time. What did we do? Well, we broke this higher low. So now that we broke this higher low, what is that again? A market structure shift. But this time, it is not a bullish market structure shift. It is a bearish market structure shift. Now, bearish just means price is potentially going down. Remember, think of it as potentially because it's not 100%. There are other factors. Think of bearish as going down. So now, when we break a higher low and we create a lower low, because this low is lower than this previous low, we are now bearish, which means we're potentially going down. You can see price goes up. We create a lower high. Remember, that is a lower high because price is this high is lower than that previous high. So hopefully all of this makes sense. Now I'll show you guys this in price action as well, but this is basically the basics of market structure, highs and lows, and how market structure works, how to identify market structure shifts. And if there's anything else that you guys might be confused about or not 100% understand, just let me know in the comments down below. So we're going to start off again. We're going to start off with our highs. Remember, we see here we have a high because price goes up, pivots down, right? So we have a high, okay? and we see here price goes down and pivots up. So we have a low. Okay, you can see we have a low, we have a high, price goes down, breaks below this low with the candle bodies, and I'll show you guys what I mean about the candle bodies after this. So what is this? When we break a low, that is also known as a market structure shift, specifically a bearish market structure shift, meaning price may potentially go down. So when we create this new low here, since it's lower than the previous one, this is a lower low. You can see price comes down, and then technically right here we get another market structure shift, right? So we have a lower high right here because this high is lower than the previous, and I'll zoom in a little bit so you guys can see it better. So remember, low here, a high up here, price breaks, creates a lower low. This is a bearish market structure shift, meaning price may potentially be going down. You see we pivot up, create a lower high, and then you see this red candle breaks below the candle body close of this low, which I'll go over after this. But then what do we see? After we create this lower low, because this low is technically lower than this one via the candle bodies, what do we see? We see price does not create a lower high, but what does it do with the previous lower high? It breaks above it. You see this green candle right here breaks above this high. It does not create a new one. So when we create a new high, instead of creating another lower high, this is now our higher high. And this is also known as a bullish market structure shift. So now we are potentially going up, right? What does price do? It comes down. You see price with this red candle, it retraces down, and we create a higher low. Why is this a higher low? Because it's higher than this previous low. And you see price goes up. What does it do? It creates a higher high. So this higher high right here, we break this previous high, which is also another market structure shift. We retrace down. What do? We pivot back up. We create another higher low, and we go up, create another higher high, and then it just continues doing this structure. And then I'll draw out this market structure break right here. So hopefully this makes sense. So remember, in this video I went over what highs and lows are, how to identify them, the difference between a low and a high, a higher low, a lower low, and a lower high, and how to identify market structure. Now the only thing I need to go over, I believe now, is candle bodies, and to do that you have to understand the how candlesticks work, which I can do for you in 1 second. So think of this as a candlestick. So we will make this one green, representing price going up. So this would be a bullish candlestick. And I'll show you guys what all this means in a second. So here we're looking at a bullish candlestick. That's what the green is representing. So to understand the anatomy of a candle, you have to understand what it means, right? So if this is a bullish candlestick, then let me show you exactly what this is. So basically how it works, and I'll make this a different color because that obviously would probably get confusing. So this line right here at the bottom of this candle is the open. So this is where price opens. So this is the open of the candlestick. Now these are kind of how candlesticks work. It's something called OHLC, which probably like thinking what the heck is that? Really it's not that complicated. It just stands for open, high, low, close. That's how these candlesticks work. So I'll draw it out for you. Open, high, low, close. So each candle has a candlestick represents the open of the price, the high of the price, the low of the price, and the close of the price. So for example, if this is a 15-minute candle, that 15-minute candle, this bottom part would represent the open, the top would represent the highest point that candlestick went. So that would be the highest point that the candlestick went. This bottom point would represent the lowest point that candlestick went. And the top of this, which is the body of the candle, which I'll represent to you guys in a second, will represent where price closed during that 15-minute period. All right, so remember, let's just remember this: open, high, low, close, OHLC. This is the open of a bullish candlestick. This is the low of it. This is the high of it. This is the close of it. Now, every candlestick obviously does not going to look like this, but this is the simple explanation of, of it. So basically, the body of the candle is from the open to the close, typically, all right? So this green portion is considered the body. So we'll write that out. That is the body of the candle, because that is how I draw out my market structure, is by the body of the candle. So just remember, the shaded area of the candlestick is the body, and the skinny area is called the wicks. So there are normally two ways to mark out market structure. Some people use the wicks of the candlesticks. I like to use the bodies. So remember, the wicks are the skinny part on the ends. Not every candle has a wick. Remember, simple explanation. And the meat of the candlestick, you could say, is the body, right? So now I will do the opposite for a bearish candlestick. So let's say that this is a bearish candlestick. Remember, not all the bearish candlesticks are actually going to look like this, but this is like the simplest form of it. So we're going to draw out, it's the same thing, just in reverse as the bullish candlestick. So remember, they still operate in the same area. Let's pretend this is a 15-minute candlestick, which represents 15 minutes of price action. So it's still open, high, low, close, except where the open is just reversed, because remember, this is going down. So we'll make this blue again. So this would be where the candlestick opens. Obviously, like I said, just remember it's reversed. So this would be where it opens. This would be the highest point of that candle, which, yes, it would technically be a low, but this is the highest point of that candle, because remember, it's a bearish candlestick. So this would be the high of the candlestick. This would be the low of the candlestick, and this would be where the candlestick closed. So kind of think of it like this, right? So the candlestick, and this is kind of like how it works. So let's say a 15-minute candlestick just opened. So price would open. Let's say it goes up, right? So remember, price opens here. Let's say price is opening here, okay? Price goes up. That would create the low. Now when it goes back and moves back down, that would leave a wick, right? Then price would go here. That would be the highest point that it went, and then it would go back here, and that's where it would close. And the highest point it went, and below the lowest point that it went, where would be the wicks, obviously what you see here. And the wicks work the same way on the bearish candlesticks, and the body works the same way. The meat of the candle is the body, the wicks are the skinny portions. So this is the basic anatomy of the candle. Screenshot this if you like, I'll give you a second. And now I'm going to show you why I use, or how to use the bodies of the candles to label your market structure shift. So I'll draw a simple, I'll draw an example of, let's just say a high, right? Let's just say price comes up, creates a high. Let's say, remember, all highs and all lows are not going to look the same anyways, so this is just a simple explanation, right? So we'll draw the wicks of the candles. Not every candlestick, every candle has a wick, so just keep that in mind as well. Most of them do, some of them don't. And some of the wicks are totally different. Like the wick of this candle could be way longer, and I'll just show that to represent it, that the candlesticks can look vastly different. And just to make this a weird one, I'll make these candlesticks like super long, all right, and one of them really short. So let's just say this was the high, right? So this would be identified as our high, okay? So for a valid market structure shift to occur, we would want to see price to close above the body of that high. Remember, the body is the meat portion. So the easiest way to draw this out is when you draw out your highs, you just draw out the close, or the top of the candle where the body is. You would draw that out, right, in a vertical line. Sorry, horizontal line. And if the body of another candlestick closes above this, then that would be a valid market structure shift. Most people would use the wicks, but I use the body. So for example, let's say, so remember this is a red candle, right? So price closed all the way down here. So let's say the next candle opens up. All right, it doesn't make it that far, right? Let's say the next candle opens up. It also doesn't make it. Let's just move this over here slightly. It also doesn't make it up to that high, right? But then the next candlestick, boom, it breaks above that high, right? And let's say we'll just draw out the wicks for this one. You see how the body of this candle broke above the body of this candle. This would be a valid higher high, even though normally it would probably just it would probably keep going and then reverse, create a high, and then price might continue and take that high out. But this would be a valid market structure shift because this candle body closed above this high. So now I'll just show you guys what I mean on an actual chart. So for instance, we'll actually draw out, we'll go up here just because, okay. And this is actually a good trade right here. Actually, I think I might have taken this trade on this back test. I don't know, we'll look at that in a second. But so what do we see, right? We'll just look here. We have a high here, right? This is a high. We have a low here. This is a low. Does price create a new high or a new low? Yes, it does. It creates a new high, which, since this high is higher than the previous one, this is a higher high. Now when price creates a higher high, what does that mean? It usually means that there's a market structure shift. So if we look at the bodies of this high, and hold on, I'll zoom in for this, right? If we look at the bodies of this high, you see how this green candlestick, right? We'll actually zoom out. You see how we opened down here. We made a wick, right? You see the wick there. Then we came up, we made a wick at the high, tiny wick, and came down and we closed. You see this red candle didn't have any wick. We opened right here and just went straight down. Doesn't look like it had any wicks at all. That's what I mean. Not every candlestick has a wick. But what do we see? We have these two candle bodies up here at our high. So we draw that out, the horizontal line, and if we get a market structure shift, then the next candle or whatever candles afterwards would have to break above that high. So is this a valid market structure shift? Yes. You see this green candle, we opened here, right? We came down, then we went up, and then we closed. No top wick at all. But did the body of this green candle close above these bodies of these highs? We did. So that would be a valid market structure shift. Now another thing, which is going to be a completely different video, maybe the video after this, we also have a fair value gap in here. And let me just do that. Price comes down the fair value gap, we tap into it, and then we continue higher. So guys, that is the basics of market structure. That is how to identify highs, what they are, the difference between lows, highs, higher lows, lower highs, the anatomy of a candlestick, and how to identify market structure correctly. I hope you guys enjoyed this video. Be prepared for part 2. This was part 1 of the full beginners course, and I'll see you guys in the next one.